Hello, hello, hello. Let's see. Okay, countdown. Okay, I'm gonna play. I have a minute here.
I want you to tell all your friends about me.
What are you?
I'm Batman.
Yeah, it's fun. Lincoln and Bacon. Damn, you guys are fast. So, anyways, figure I'm a night owl since it's Friday. Um, what the hell? So this kind of I was doing my research on Pfizer, and it's kind of relevant actually to that topic to talk about Costco because there were some posts on Dividend Reddit about all the hubbub about this $15 special dividend. So I don't own Costco stock for it's whatever it's in, some ETF basket, I'm sure. So I don't really have, it's funny though, because I don't have Costco's here. They're really not a thing in the Northeast. I think they're trying to get into this area. Man, I could the legal fights they've had in my area to try and get here, they've spent years, maybe 10 years, a decade trying to get into my area. They'll pick a site, it'll either bring up issues with code, the zoning board or local residents in the nearby areas would sue them and then sue them again. Then they'd want to level a forest to build the Costco, and then they'd get sued by some other government agency to stop it. So, man, so that's relevant to this discussion actually, which we'll get into in a second. So that little piece, but so here it is. Um, Costco announces a $15 special dividend. I have a company that pays special dividends, AGCO. So AGCO does too. Other than that, let me see what other special dividend company. Packer does a special dividend also. So what they do is so special dividend, not the same as what Costco's are not regular. Agco and Packer have decided they're going to pay a smaller quarterly dividend that they still grow, just not by a lot. And then they've decided they're going to pay a special dividend, and they're going to base that on the management's decision making at the time. If they find other avenues that they could use their capital, they could reduce the special dividend if they find something worth investments. If they don't, then they could increase the size of special dividend, return more to the shareholders. Um, I like that. Like, no, is any of this like a deal breaker, or I'm only going to buy companies that do this? No, but it's interesting. So Costco returns value to shareholders through these special dividends. Um, so I can only tell you what I think of it, as a mostly dividend person. Um, I don't hold individual companies long term if they don't pay a dividend. So I will trade them, swing trade, but and maybe I get into that more and more as we go on. But you can see, so they have the cash. So we get some interesting tidbits out of this. We find out that they do have the cash. It's going to cost $6.7 billion to pay the special dividend. I can go to their balance sheet, which I hope this is right, because sometimes when they upload the most recent quarter, stock analysis is tough. I use stock analysis because it's easy to show on YouTube. It's harder to show like Stock Unlock or some other ones I've used. This is just easier to show you. So, I mean, they have the cash, right? So they're sitting on somewhere in, 17 billion of cash and equivalents. So they're taking about 6.7. So they have the cash. So they're not going in debt. They're not doing some other shenanigans to pay it. So that's good. So they are returning excess capital that they have not felt they have a need for, to your benefit. Now, to your benefit, you think, oh, they're not creating value. Of course, they're not creating value. This argument is very odd. Okay, they're not creating value. You're not creating or taking away value. But then people always say, oh, you're not creating anything. Okay, well, you're not taking anything away either. All right. So you're returning capital, you're reducing like retained earnings, and you're giving the shareholders the cash. So here's the point I always look at. Okay, the cash has been generated. So my question is, basically, what do they do with their free cash flow? So we can get to this part. So we've established they can pay it with cash. They Before we get into this, if you look at their free cash flow, they're doing great. Operating cash flow, I mean, my God, glorious, right? This company is a cash machine. So free cash flow looks great. So I can look here. They can afford all this. They're doing great. Um, so they're not in trouble. Um, so we go. So here's companies' options. I don't know why people get so butthurt about dividends. Like people get mad. I don't know why. This is all you can do with okay. What do you want a company to do with their money? And this is every company. Hopefully, at the end of operations, has free cash flow for operation. Right? Hopefully, they have money every quarter from operating. Obviously, some don't, but so what are they going to do with that money? Right? This is what you pay CEOs, managers for. So, do they pay a dividend or increase whatever the established dividend is? Share buyback or some sort of share repurchase program of some sort. They can do additional capital expenditures, which means they're trying to grow organically, right? So they're trying to develop, maybe they want to like in Costco's case, you could say capex would be maybe they want to refurbish stores. Um, Maybe they want to invest in some sort of new checkout system at the front door. Maybe they want a new software program to track membership, or they want to refurbish their online presence. So these are all organic internal house choices they could make. Okay. They could also pay down debt. Here's another option. They could also, here's one that you don't see this in a lot of lists. Usually they just list five. They could do nothing, right? That's an option. They could do nothing. They could decide not just like you could just do nothing with your cash and let it sit. And then the typical external growth, not organic. So mergers and acquisitions. So these are the decisions your managers make. None of them are better or worse than the others. I can't stress this enough to people. Like when you say like they should do this one rather than this one, or this one rather than this one, and you apply that across different types of companies in different industries. I'm like, I don't see what you're talking about. Um, Different companies could have different situations where some of these make sense, at sometimes some don't. To just broadly say dividends are stupid, share buybacks are always better because of blah. It's You're making broad sweeping statements that don't make sense and are not factual. To say, well, dividends produce taxes. I mean, they don't create additional taxes for the Costco, they create additional taxes for you. But they don't, the dividend doesn't know if it pays taxes. All right. They pay dividends to people that own Costco and a Roth or 401k or some sort of ETF. How the hell they don't know the dividend, don't know if it's paying taxes or not. So here's their choices, right? You can evaluate management on which one choices of these six they do. You can do that, which is what I do. Um, so they had the cash. So we can go through this. Pay a dividend that they chose to do that with this cash. Okay. A special dividend. They also grow their dividend at a pretty good clip, actually. So if we go to Costco's dividend growth on Seeking Alpha, you can see 1 year they've grown it at double digit 13%. 3 year, same about 13. Where's the 5 year? 10 year, 12. So this is a very consistent company. Let's call it that, consistent. So we can look previous, 24, 26. So, consistent growth across broad strokes of time. That's good to see. Like it. So, um, so they're doing both special and increasing the quarterly dividend. Um, Buy back shares. Okay. Okay. Let's say they should buy back shares because it's more tax efficient to buy shares back. Blah, 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 whatever. Always about the damn tax efficiency. We can go. I mean, the is anybody going to debate this is an expensive stock? So they've decided they're not really buying back shares much. I mean, you can look. They buy back some shares, but you can see it's pretty flat, right? So I can go to the cash flow statement and you can see right here, shares repurchase. They are repurchasing tiny amounts at the same time that they are issuing shares. So they're paying for like share-based compensation here. They're basically just repurchasing enough just to cover themselves. So they're not in that game. Now, you could argue they should just who cares? It's always better. I mean, Apple, okay, an example of that would be like Apple. Apple literally just buys shares back every quarter with their cash flow. They don't care. They don't seem to care about valuation and buying the stock when it's cheaper. Apple just buys their own shares back across long periods of time, whatever price. They're not being efficient with it. Um, Another example of a company that was just buying their shares back at any price was Meta. Meta was doing this before they got wrecked. They were buying back shares when the company was like $300. I don't think people forget. Do people forget that? So this that can turn out poorly. Buying your shares back at the wrong price, and then something bad happens in your company. So that's not a perfect solution either. Again, I'm not saying any of these are better than the others. I'm just saying if you tell me one is better, I don't understand why you're saying one's better than the other. It depends. Okay. Additional capital expenditures. So we can go to here. So this company, Costco, runs 861 warehouses. Okay. So these are get back to the story I mentioned at the beginning. These are massive buildings, okay? Massive. They take a lot of work to make these things. Like I said, it's taken 10 years almost of fighting to get one in my area, and it's still not done. They've gone through lawsuit after lawsuit, government, neighborhoods, zoning board issues. It's tough to get these things built in some places, right? These are massive buildings. This isn't like a GameStop. You could put in a plaza. So to say they should just dump that money would be better used capex. Like they should be building more Costco's. I mean, well, it's difficult. It's hard to build these. Even I just listened to the earnings call. Someone asked him about expansion, and he's like, they have really fast growing, profitable stores in like South Korea. The problem is they can't get the real estate. So their impediment is building these things because they're big buildings. So that's not really an effective use of that capital. I would argue, saying that they should just go on a massive expansion. That's not what they've ever done. So that's outside of what they've always within the norms of the company. So just expansion. They have a solid plan. They're sticking to it. They're not wavering from that. I think if you just said who cares, they should just expand further because anything's better than giving the money back to shareholders. I mean, you're making the company deviate from what management wants to do. That could turn poorly for you. That's not a perfect solution either. Like I said, and they don't have it's not that many stores, so that's you know, I mean, you could say, okay, well, they should expand their website, more software development, maybe. I mean, these are options management. They are spending capex into those things. I mean, you can disagree with them if you think they should put more into it, but again, it's an opinion. Pay down debt. Okay, there's another option, which I won't disagree. Some companies that do huge dividend pay raises all the time, double digit dividend growth, a lot of them probably should pay some debt down. Won't deny that. Very true. We can go look at Costco's debt. So we'll be looking at, we'll just see if, make sure Seeking Alpha's got okay, we do have the most recent quarter. Long-term debt. Okay. I mean, that's it. So they have well more cash than the long-term debt that they would pay off. And let's be realistic. Company doesn't need zero debt, right? Companies all have debt. They all have they all have some sort of bond issuance or something like that. So to say pay this to zero, it's like it's fine. Like it's not growing. They have a reasonable amount of debt. So I mean, again, it's management decision. I say paying this debt is better for them than giving you the money back? I would not. Um, I think either option's fine. In this, it doesn't seem like it's a problem. So that's up for decision. Rainy, save it. Do nothing, right? Just sit on piles of money. Why would you give it back to shareholders? What a waste of time. You're making the company less valuable. Okay. So you can argue that. This is something I've always been I get concerned about. So companies, and this will tie into Pfizer, I think. So the next video will be Pfizer because I want to talk about Pfizer had the greatest year of the company's history. And this is like a 100-year-old company. 2022 was the greatest year Pfizer ever had. $100 billion of revenue. Um, in October 2022, they had $36 billion of cash, which was like the final war chest from COVID, the vaccines that they developed. That was like the culmination of everything they did with the COVID vaccine, the greatest year of the company's life. What's happened since then? The stock price has almost been cut in half since that happened. Their cash dwindled. So we'll get into that in the next video because, like, what happened? Because you would tell me just sit on the cash because anything's better than giving it back to shareholders because that's a waste of money for the company. Okay. Pfizer had a big pile of cash, and objectively, we can say like a year later almost, they failed, right? Because the market cap's like cut in half almost. So we'll go into why. What happened? What did they do with that capital? Because they spent it, believe you me. And you look now, they have more capital now than back then. It's because they did a massive bond issuance to pay for a merger. So that company's in rough shape. You could almost argue that huge pile of cash actually was a detriment. Maybe I'll try and make that case. It didn't help them because we can look back now. That huge pile of cash didn't do the company well. And I kind of thought at the time they were going to piss the money away. I didn't think they had a good track record of managing some outsized amount of money they've never had before, except for when they do like a big bond issuance for something. So here's a paper I've had for a while. So I always like to research like agency cost or agency cost. I don't know if you've heard this term before. So let's zoom this in. Before I get into this, anybody have anything? Let's see. Okay. Dang, that local really not. No, they do not. They're still fighting it. Yeah, the first location they picked, it was stupid. It was the dumbest location. The traffic pattern would have been just a complete nightmare. They wanted to put it next to a highway ramp. And this highway ramp is so busy during rush hour. And I hate to say it, but like 10 or so people die at this intersection every year. Just traffic accidents. It's a nightmare. And they wanted to put a Costco right there. So thank God the zoning board said no to that location. Then they tried to go next to the mall, which is next to a neighborhood, an old neighborhood. And the HOA is like not, they're fighting tooth and nail. It's gone to, I think, the state Supreme Court. The stock will down dividend amount. Okay. Like we said, like at the end of this, we'll talk about dividend capture kind of because it's kind of funny. Like I said, people like go crazy about this. You didn't create value. You didn't lose value. Like people can relax. Let's question what I think the question's more is what is the company doing with their cash, and do you agree with what they're doing? And I mean, we can look at the history. People want to like make fun of dividends. You want to make fun of dividends, okay? I'm just telling you, a lot of your returns, if you're an index investor over long periods of time, are due to dividends. It's just the math. It's been studied before. Most of what you make investing long term in the U.S. markets, most of your return is due to dividends historically reinvested. So to say that, I mean, you benefit from it whether you think they're stupid or not. The thing people don't understand, I think, is that like profitable companies, like the top 500 in America, because there's like 3,000 companies. So this is like those 500 represent the top. These are insanely profitable for the most part corporations compared to like the rest of them. Look at what small caps have done nothing in the last year or so. It's all been the top, but these are insanely profitable companies generating huge amounts of cash. So you can't expect them to have a good plan for all that cash they're generating. It's so much cash coming in. To expect them to organically expand or do mergers or anything but pay a dividend, you just take that option off the table, is just so odd. I would always tell you a company should stick to their guns and they should have a certain expectation of a return on invested capital before they make investments. They shouldn't just say anything's better than giving the money back to shareholders. I don't think that's true. You can look at a lot of the most successful companies in America and you'll see similar patterns. They have very steady, if not growing returns on invested capital. It's not like shrinking. So if you just say anything is better than giving a dividend back to shareholders, you're implying that you would accept any return on invested capital. You don't care if you would want them to make something that would pay a 5% return of capital, because right now they're at like what, 18. They hover around like 18 or 17 to 20%. So by your logic, you want them to, anything is better than dividends. So they should invest in something that returns 2%, 5%. You don't care. Um, I don't think that's a sustainable and proper way to manage capital at these large companies. Um, they just need to take some of this capital they generate, these huge piles of cash, and do something with it and take it out of managers' hands, because management can screw up for different reasons. Um, so back to this. This is something that's always been part of my thinking about investing. How do you know? So the agency cost is the conflict between management and shareholders. So how do you know that management is making decisions that are in the best interest of you, the shareholder? There's no answer to this, right? This is like the never ending question. And we can look at Disney. Bob Chapek, I guess we could say there was a huge issue there because basically shareholders were screaming for him to get fired, right? So is the manager doing the things that are in his best interest or shareholders? This is the never-ending conflict of investing, agency costs, right? So that's what they call it. So if you want to say, so let's say a CEO is going to do what he's got to do to keep his job, right? So let's say say there's like full conflict here. He's not really doesn't give a crap about shareholders. He just wants to keep his job, right? You give him a huge pile of cash. What is he going to do with it? He's going to grow. He's just going to make the company bigger, because, or maybe he has a financial incentive package from the board that incentivizes him on things like market cap, or other metrics, just bigger, right? More revenue. He doesn't care where it comes from, just bigger company. So now you've given him the wrong incentives, let's say, for the benefit of shareholders, I would say. But this is like a famous paper from the 80s, Michael Jensen. And I always like this part. Managers have incentives to cause their firms to grow beyond optimal size. Growth increases managers' power by increasing their resources under their control. That's another thing. I mean, I'm sure these CEOs, these are like cocky alpha people. I'm sure they want to be like, they want to be a 50 billion market cap company, and then now they want it to be a 120 billion market cap company, right? These guys have egos. So is that the best thing for you as shareholder? I mean, we've seen examples of not. Look at what happened with General Electric. I would argue that happened with General Electric to some degree. They just wanted to grow and grow and grow so that the CEO is like, I have a bigger company, I'm more powerful, and all this stuff. And it imploded eventually. So this can backfire on you. It also associated with increased managers comp. Yeah. So like I said, like managers can have incentives of bigger company, doesn't not leaner, just bigger. And they can have incentives that compensate them that way. Now this brings an agency cost. Are they really acting on behalf of you, the shareholder? And just think about it, people are people. You're going to give a person in charge a big pile of cash. He might make different decisions that he never made in the past at that company. Maybe he does invest in something that has an ROIC like lower than what their normal is. People look at what happens when people win the lottery, right? They go bonkers. They go to jail or they're broke in a few years. So it like broke what was working for them for all this their life, and like they didn't have facilities to like deal with it. So to say just do nothing with it, I don't know. I don't like that option. That's the one I don't like the most, is telling, if you just tell a company just sit on the money. So why should Costco sit on that $6.7 billion they paid back to shareholders? Why do they get to sit on it? I'm a shareholder. Let's say I'm a shareholder of Costco. So they're going to say, well, we don't have anything good to do with the money. We're just going to hold on to it. It's like, but I'm an investor with a stake in the company. Give me the money back. If you don't know what to do with my money, the money as a partial owner, give it back to me. This part I like too. Free cash flow is cash flow in excess that is required to fund all projects that have positive net value when discounted at relevant cost of capital. I'm tired. Sorry. Conflicts of the interest between shareholders and managers over payout policies are especially severe when organizations generate substantial free cash flow. It creates conflict, right? The problem is, how do you motivate managers to disgorge the cash rather than investing it at below the cost of capital or wasting it on organizational inefficiencies? The never-ending agency conflict, right? He's that manager has incentives that might not align with you, the shareholder, and then now there's a big pile of cash sitting between you. Um, so an option is to give it back. Shareholders take it off the table, right? Take it out of the equation, which companies do. Because in the end, investing in companies is about returning capital to you someday. Either someday in the future you sell the stock or that you collect dividends and hold on to it for a long time. It's still the same equation. Um, Mergers and acquisitions. I always use the example, like McDonald's is a cash flow machine. It's just a beautiful model, and they give double-digit dividends back to shareholders, right? So mergers and acquisitions, like what possibly do I want McDonald's to buy that would align with what they've done successfully for all these years running the franchise system? So I've always said, like, their ice cream machines break. Do I want McDonald's to go buy an ice cream machine business so they can run it themselves? Like, no, I don't. I want them to stick to what they're good at. They're good at running McDonald's franchises and we'll see if they can run the Cosmic stores soon. But this is usually honestly the worst idea possible because like you overpay when you buy other companies. Just assume you're overpaying for it because that's the nature of the beast. You're telling that other company you're going to give up your future prospects of growth in that stock. So we have to pay you more than what it's worth now. Otherwise, the shareholders would tell you to go, go to hell, basically. Um, so you always overpay for mergers. So is that a great, there's plenty of examples I can give you of companies that just merge and merge and merge to get bigger. General Electric, right? A lot of pharmaceutical companies, Pfizer, which we'll dig into that. Um, so these are their options, and I can make cases. Different companies have different scenarios where these work. Some of them work. You could do a case study make of Apple because, like what I said, Apple's chosen to do tons of share buyback. So and hold cash, honestly. So they've done like these two. Um, that's a different story, but let's see who else. The clip. Oh, I already clicked that one. Wonder if Agco is going to grow special dividend in June. Yeah, it'll be interesting. It's different because Costco doesn't do it on a regular schedule. Agco is going to do it every June. The plan, unless they change it. Um, Ignoring the cute stock dividend, people part of the dividends. I do admit the tax laws matters. Choice of differences. I mean, it depends. Like the tax consequences, 15%. This is why I was like long-term dividend investing, qualified dividends. It's like it's 15%. I've never had a huge tax bill before. Um, it's not a big deal. It's honestly not. I think you should. It's not something I worry about. Or some of it's in tax deferred accounts, so it doesn't even have a tax repercussion. Um, but I usually you can't assume a company has a good use for all the cash they generate if they're a good business that has a growing free cash flow. All right, sometimes they're just creating more cash than they know what to do with it. Um, and to say you should take any of these off the table, like these are the options at hand for a manager. They all could be good in different scenarios. All six of these could be good depending on the company. So to just like cross out one because of whatever taxes, it's like it's kind of foolish. I could argue share buybacks in a lot of cases are foolish too. A lot of companies do share buybacks like crazy, and then the stock drops, and then it's like, bet they would have wished they had all that money when things went bad all of a sudden. So that can turn out rather poorly for a company because a dividend they can just cut it, right? They cut the dividend, blah blah. Blah. But those share buybacks are gone. That capital's gone forever. I mean, jeez. Oh, Costco, Dave Ramsey, the debt. Oh God. Companies don't have zero debt too. I always think that's funny if someone says they should pay all their debt. I mean, some tech companies do, but even the tech companies have debt. I mean, it might be like leases and stuff, but so far so good. Yeah, yeah. So this is always why I like this is something I struggle with. And you could say like a dividend represents some sort of commitment that management has to shareholders because that is and you listen to enough calls where they talk about like a commitment not of a dividend amount but of like a percentage of the free cash flow they'll commit it to returning to shareholders. So it's like showing that they care. I don't know how like is it everything? No, it's not. It's just something to think about. It's giving you some sort of breadcrumbs that okay, management, maybe there's not a conflict or less of a conflict. I feel good about this. So that, but this is always something I think about. Like, I'll be honest, like I think Alex Karp. I don't think Alex Karp at Palantir gives a shit about shareholders. So they need to really think about this. I don't think he cares. I think he makes decisions for Palantir and himself, my opinion. But that's the dilemma you face investing in a company. How do you know that they're making decisions for you? And dividends could lead you to that end because the dividends are taking cash out of the company, so it's making the company yes smaller and giving it to you. So it's good for you. Is it's good for you, not good for the managers. Let's say, easy terms. Um, Holy shit, who's this? Microcap Maniac. Oh, that's right. I forget that I'm on Twitter. I click both. Oh, you might be my first Twitter comment. I don't know. Maybe not. Um, okay, so let's pivot slightly. I could do another video on this, but maybe full. I just want to I don't even know how to phrase this. I could show so many spreadsheets and research that's been done on this, but in the end, dividend recapture for and I saw this being talked about Costco because of this the $15. So people are like, I'm gonna buy it and then sell it and collect that. Okay. Dividend recapture doesn't work. It doesn't work. Okay. I can't stress this enough. It does not work. I could spend 40 minutes doing a video telling you why. It doesn't work though. It can't work. Like I don't know how to phrase it. Because if you imply dividend recapture works, that okay, so the theory is for people, maybe someone doesn't know what this is. You could Google it. You buy the stock X dividend, right? You capture that dividend event, the share price goes down the next day, and then you sell it. But the theory is it doesn't go down as much as the dividend, so you have netted money now. Say it goes down $2, but the dividend's 15. Okay, you've just made $13 the next day. You're awesome. But if you if the stock market doesn't create money, okay? So if you win, someone loses. So like I don't see how in the modern age of technology and algorithms and computers trading, if this worked, don't you think every firm in don't you think every firm in Wall Street has tried or has thought about doing this in the past? This is probably one of the most researched things I've ever seen in the markets. Like every firm, every retail investor in dividends has always like, hey, this is like one of their first ideas. Hey, why don't I just buy it before the dividend and sell it after? It's so broadly talked about. You have no edge. You're not going to be the one to figure this out. It doesn't work. Like I said, someone has to be on the other side if you're winning on these. Someone would have to lose. And then someone, if it did work where say we saw somebody claiming you get 300% returns per year doing this because they use like an algorithm, some hedge fund guy, don't you think everybody in Wall Street would then pile into that strategy and then your edge is gone immediately? This doesn't work. I mean, this guy did an extensive write up on it um, on Dividend Reddit, and I saved this article. But he ran it, and yes, what will you will win and you will lose some of these if you do this over broad periods of time, buying it before dividend and selling it after. You know, it's the market return. In the end, that's what's happening. The stock always drops because you're not creating money. You're not create money. So the stock has to drop. Now, the next morning, it probably won't be exactly the subtraction of whatever the dividend is because it's trading on the market. But that happened at some point. The stock dropped that amount. Then the markets take over and then it can go up and down based on the markets. So it's still, if you do this broadly, sometimes you're going to make money, sometimes you're going to lose. But I'm pretty sure in the end, you're going to lose money. It won't work. So still, you're investing in a company long term. If you like Costco, you're buying it because you like Costco. You're not day trading or dividend recapturing it. It won't work. Maybe I'll buy a share of Costco to show you. Although the correct research would be to do it off, broadly, like long term, many different stocks to show you that in the end, it's just not going to work. So here's a good example. So Jake Bro did this. I remember this video. Let me pull it out so I can play the clip. Okay, because I have to switch. Hold on. No, that's the wrong button. Okay, share screen, Chrome tab. All right, hopefully the audio works. Tell me if it works, Bacon.
Guys, Jake here. I lost a lot of money. However, I did it for you guys. I did it for the viewers. And in this video, let's cover exactly what I did, why I did it, and what we can learn from it. On my channel this year, I'm experimenting with lots of different kinds of investing strategies, and one of them that I wanted to explore for you guys was the dividend capture strategy. Now, at the beginning of the month,
so I bet you guys didn't know that Jake Bro was a finance YouTuber before Ukraine. So he did like options trading and dividends and various topics. I kind of miss those days to some degree, but
I made this video, the dividend capture strategy, bad idea. Then mid-month, I did an update talking about my progress. This video is the third video in this mini series about the dividend capture.
So there's 2 other videos. You can go check them out. I'm just going to play this one. So
Next dividend date. Now my account is currently at 21,937, down 11%. However, I still have dividend payments coming. It takes, once again.
So he every day for a month, he bought a company and then sold it the next day after the dividend or after the ex-dividend. So it was like an experiment, and you could see the results. It's down over 11% down.
A couple weeks after the ex-dividend date before you receive a payment. So I haven't lost this much, but I did lose this much. Here is my Excel sheet tracker for the.
So you can see what happened, what I just brought up. So this is you can see here the loss. Sometimes he made money, sometimes he lost money. Okay, it's still the market. You're day trading basically. Let's be real. You're day trading, doing dividend capture. You're trying to buy it and sell it. Okay, swing trading, it's 2 days, it's not 1 day, whatever. But it's the market, right? So some of them make money, some of these lose money, and then he lost in the end. It didn't work. So he factors
the entire
dividends
month, and
then
I
the
net
final
lost $1,510. For the month of July, there were 21 trading days, and I picked a different stock to jump in and out of each day. There was one day where I couldn't get to my computer, so I couldn't trade, so I did miss a day. So there were 20 dividend-paying stocks that I did jump in and out of every day of the month. And when you look at what the dividend yield of these companies is, divided by 4 if they're quarterly dividends, I should have made about 12% of my money this month if the share price of the company doesn't drop exactly by what the dividend payout was. So this is the dividend per share payment. Standard is about 12% of 25.
Okay, so you can see dividend profit was here. So he made $2,636 dividend profits, but he lost $4,146. So some days he made money, some days he didn't. Okay, that's what's going to happen.
1,000. So if the share price of the company doesn't drop by what the dividend payout is,
and I can tell you, if there was even the slightest of alpha doing this, somebody on Wall Street would just create an algorithm and just do it on every company in America every time they pay a dividend. Even if it was the slight, just think about it. It wouldn't even have to be like that profitable. Even if there was the most slightest positive, like tenths of a penny to do this, they would do it. So you got to understand, like, if something's well known, like this well known and this researched on Wall Street, like it's not going to work. You're not the one that's going to figure this out as a retail trader. What else do I have you're not going to be the one. It doesn't work. This could have worked maybe before the age of the internet with broadly, shared information and easy trading where every person has a phone, and before supercomputers. Like maybe this could have worked in the 50s and the Ben Graham era, because your edge could have been the dividend knowledge, because maybe everyone in the markets didn't have like the sheet that actually showed when these things were bought and sold. Maybe it could have worked back then, but it's not working these days. It won't work. And if it did work, they would do it better than you, Wall Street, rather than you on your Robinhood cell phone trading these things. You have no chance. It won't work.
Then is
Oh,
I don't
see, sure.
you can only gain value from the stock by one of two ways. And I know people who love dividend stocks say that dividends then sell shares to pay yourself passive income. That's the equivalent of being.
So that's the part of it. So anyway, let's get back. But yeah, anyway, so this example, you can see it was 3 months ago on Reddit. Dividend capture strategy doesn't work. Let's investigate. If you want to go read this, I could probably link it in the description here. So, but he says like right here, this strategy is not, you can't read this, sorry. So this strategy is not 100% dividend capture. It's something like 30-40% dividend capture and 60 to 70% capital gains. The market. So it's the market trades. Like, so it's not even a dividend capture. That's what I'm trying to explain to you. You're literally just like, you're swing trading stocks. And go look at the statistics. Swing trading stocks over broad, if you do it like every day, day after day, you're going to lose. Statistically speaking, there's nothing different. And you're going to pay a lot of taxes, because this is all short term cap gains, because it's not qualified, not long term. So he tested this. I think it was JP Morgan and Next Energy. But you can go check it out. I don't want to read this all. Like I said, long periods of time, dividends are great, but that it's not this recapture is not the way to play it. You just buy a company and hold it. Costco is a great example of a successful free cash flow growing company that rewards shareholders with dividends. So they have the characteristics I would look for in a company. And this paper, I went over, this was a video from when I first started my YouTube channel. So you could check it out actually. But I always like this line. Corporations that consistently grow their dividends have historically exhibited strong fundamentals, solid business plans, and a deep commitment to shareholders. So you could say, it's kind of like my final thought here. You could ask yourself, look, is Costco a good company because it pays a growing dividend? Or do companies that pay a growing dividend have characteristics that make them successful companies in general? So I think most people look at it the wrong way. I think you all focus on this part. You should focus on the second question. So there it is right there. I guess that's a good end. And let's see. I don't know what questions you'd have, honestly. Audio good. Okay. Dex. Some tool on dividend subreddit always posts that he's buying before X to capture the dividend. Okay. Good for him. Dividends. Dan. Well, I don't want to do all dividend. Plus, when I did the dividend name, every time I typed it into YouTube, it would spell correct it. So I'm like, no one's going to be able to find me, because the you literally couldn't type my name in without it correcting it to the correct spelling. So plus I wanted to talk about more things anyways. So I think it's great content. So you tell me that I should build a snowball. Here's what, if you want to really, do I think you should grow a basket like I did of individual stocks? No, because I didn't really understand ETFs, and I didn't have access to a 401k until I was like in my late 20s. So now what I know now, it's like, why do it? I mean, you can grow a dividend snowball and by just buying one of, like, there's like a handful of ETFs that have done great. and then you take out the individual stock risk. So you can do dividend snowball in a better way than I did, I think. And then maybe have a few companies that you really like. Maybe, you do like DGRO or VIG, but then you also have some ownership of like Apple and then Costco. Okay, cool. I think you're off to a good start. Or you take a spec shot at some small up and coming company that could work out. But you're not wrecked if that company could just give you a little bit of alpha over your index return. But there's better ways to do it than how I did it, because you have more information than I do. I did. What? Got on the credit or capital? I don't, dude, learn how to type. My God. More's free money. Like, so again, like if you join, like, this is it. Like, it's just one of the options a company has. So you should assess the company itself. If you're trying to make broad sweeping statements that some of these options are worse or better, okay, like it depends. Like certain like certain industries, yes, there are better options. Like obviously CapEx is important to certain industries, right? Technology companies, Caterpillar, it's important to keep on the cutting edge with both bulldozers, right? So some companies this matters. Some companies like carry lots of debt because everyone in their sector has lots of debt. It's just the way they operate. So to say, oh, pay their debt down. It's like, well, that's how that they operate. They carry lots of debt. Some companies, just by how they operate. So you don't have like the magic solution. It depends, right? To me, McDonald's paying a dividend and some share buyback, because it's kind of an expensive stock and it always is. And I don't want them to do mergers, and I don't see the need for them to hold giant piles of cash because they collect franchise fees. So they have steady cash flow. So I want the money back. I don't want them sitting on a bunch of cash. Give it back to me. I can invest it better. Pay down debt. It's like, well, to what degree though? I mean, again, like you don't need to. We're not Dave Ramseying this with companies. It doesn't need to go that far. Anyways. Oh my goodness. Look at all these comments now. You guys are trying to keep me up. Dividends are basically magic internet money. Oh yeah, free money, bro. Are you going to retire off dividends or through selling shares? I'm not selling shares. Listen, I got plenty of dividend income. Don't need to sell no damn shares. I don't. I mean, I could get an argument with something, but like, why would you buy something in retirement that doesn't pay a return to you? Like, I mean, you could be like a growth investor your whole life. So like if we let's talk about retirement, I guess I don't know why you'd buy something that doesn't return capital. The implication that you would sell a certain percentage of that stock to fund your lifestyle. Well, then you're exposing yourself to like the risks of the market. So now you've got to sell a certain percentage of your portfolio. And, inflation keeps going up and the cost of things keep going up. The market could go bad for like a year. Look what happened in 2022. You would have had to keep selling. Now look, if you were retired, like if we look at like if we were retired in 2022, you would have sold all through 2022 as the market got wrecked. 22%, or I think 18% was the last. Market lost like 18% of its value, and the whole time you're selling 4% of your shares to fund your lifestyle, and then all those shares you sold missed the rip this year. I don't see the point of that. Or you could have a dividend investing strategy when you're tired and you don't have to sell any of it. You buy things that responsibly grow. Go look at Gen X Dividend Investor. He doesn't sell stock. What he usually does, he has dividend growth companies, and then he also takes like 20% of the dividend and reinvests it in the stock. So he's getting the growth of the company's dividend and he's getting some partial reinvestment. That dude's living on he's created a portfolio that can last for generations. And that's his goal though. He said it in certain videos. But mind you, he's got like $2.5 million. So this is the problem with like people that buy Tesla. Like, you don't have enough cash to retire. Like they're trying to create the dividend snowball with like $80,000. You just don't have enough capital to do it. So you probably realistically need $1.5-2 million to to do a sustainable growing. Now you could do a dividend investment retirement strategy that would just, fund you for, your life. But to imply to create like everlasting growth for like generations ahead, you need more than you think. But um, I don't know. I don't understand why you buy something that doesn't return capital in retirement. For me, everything's going to generate return to me when I'm retired. Even SCHG returns capital, like all of it does. It doesn't have to be a lot. I'm not saying it has to be like 12, 14%, but it has to return something to me because I don't want to have to think about selling it to return any I don't want to have to sell it to create return for me. So yeah, even SCHG, it creates a yield. Dan, do you know Costco's credit rating and their cost of capital? Not off the top of my head. I don't feel like looking it up. Wait, it came from a Magical Realm bank account. Magical Bank. Yeah, free money, bro. Evening, gents. Hello, how are you doing? Evening. Why'd you put it in print? Oh, I get it. So that's it. Wow, almost an hour. Yeah. So next up, kind of like a part 2 of this actually, because they kind of go together. We'll talk about Pfizer. So we will look into Pfizer and what the hell happened to them from last year to this year. Friggin' I'm still looking it up, so I don't have any solid answers. What happened, right? Company it got to the top and it's falling down the hill. So maybe I figure out why. What did they do with that pile of cash? Maybe they should have given it back to shareholders. We'll find out. So other than that, Christmas around the bend. So hopefully I've survived 3 Christmas parties. So it's been fun. So Christmas is almost here. So hopefully y'all have a good season and watch out for my next video. Okay. Thank you.